What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is April 22nd of 2020. Well, folks, I hope you all are having a fantastic day wherever you are, and it feels good to be able to say that yet again here on the channel. As some of you may know, yesterday I received yet again another random content strike on a piece of content from a very long time ago on the channel that didn't violate any of the community guidelines. And as many of you might know, YouTube has an automatic system that again is basically scanning content in this case, or taking in community reviews in this case, and flagging content for certain violations. Now, again, a lot of us don't know what causes this. I mean, this has been persistent in the cryptocurrency YouTube space for a while. Many people like Ivan on Tech, Box Mining, The Moon, all kinds of different content creators, including myself, have had to deal with this. And we still don't know exactly what causes it, and not just specifically for crypto channels, but banning in general for a lot of different channels. We don't think in this case, or at least I don't personally think, I don't want to speak for others, I don't think it's so much YouTube trying to censor crypto. I think more than anything, what's been going on here is that there are certain kind of key terms, key words, or key discussion points that are related to other certain topics related to crypto that might be maybe triggering that system, and then someone else is abusing the flagging mechanism for YouTube that's been around for a long time. I think there's a sense of coexisting between those features. But anyways, again, we're all just guessing at the end of the day. None of us really have a clue about what's going on because it's difficult to reach someone at YouTube. So let me go ahead, before we dive into the content today, the title is everything we're going to be talking about. It's what I actually originally recorded yesterday. It's completely relevant still. I want to go ahead and take two quick procedures. I want to make it very clear, if you guys want to stay tuned to what I do and what I speak about on a day-to-day basis, and on the off chance that something goes wrong with YouTube, please sign up at the email list down below in the description. That'll make sure that I have a way to contact you guys if I need to, in order to reach out to you if YouTube were to shut down my account, or if I were to get strikes and not be able to get a moderator to look over it for the next couple of days or weeks. It's just something that we have to deal with, right? I'm not going to spam you with stuff. I'm only going to reach out to you on the chance that the YouTube channel gets removed. And second off, if you guys are interested as well and possibly staying tuned to my startup that I'm working on, we're going to be having an announcement sometime in later May. So if you're interested in that, please sign up on that list as well. I'll let you know when the startup drops so you can test it out. Anyways, let's go ahead and dive into yesterday's video. What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is April 21st of 2020. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, as you've probably guessed from the title, we've got to step into the twilight zone and discuss the current reality of negative oil prices. Now, I know that this probably leaves a lot of you with a lot of justifiable questions. Many of you probably asking, Nick, how can this happen? How can such a widely used commodity go into negative territory? Maybe I could understand it going into the low single-digit range, but how does it go into negative territory? Is this something more short-term or long-term? And then, of course, the question we're all asking, does this mean we can get paid to fill up our tank at the gas station? Lots of important questions to talk about as we go through this very interesting historical phenomena. And also at the end of the video, for those of you interested in solely crypto, we've got a really interesting interview with the Thai at the end of the video through our sponsor eToro. So I recommend you stay tuned for that and check that out towards the end of the video. We talk about the halving and a few other things. Anyways, let's go ahead and dive into the topic for today's video, because this is a really interesting phenomena. And if you haven't noticed through all my rambling right now, according to TradingView.com, oil is up 177,788%, and it's changing every second. We just dropped another 100 percentage points. So why is it now that oil is back up to $16 now and everything, you know, and we're up 177,000% for oil? What really happened yesterday, I think, is the important question to talk about. And I want to go ahead and dive into this. So we can see here, whether we're taking a look at CL1, which is the light crude oil futures traded on the New York Mercantile Exchange, we went down all the way to negative 40 a barrel. So we were not only just trading at $20 a barrel 24 hours earlier, we actually knocked down the price that we're at, and we doubled that into negative territory. Along with that as well, on US oil, in this case it's CFD, a contract for difference for oil in this case, we saw that we went down slightly towards negative territory, traded right around negative 0.02, or basically zero in this case. Again, I think for these contracts, they can't actually, it actually looks like it traded exactly at zero. So these ones can't actually go negative, where on the New York Mercantile Exchange, the CL1 light crude oil futures can actually go into negative territory like they did. So I want to go ahead and talk a little bit about this, right? This is obviously having massive ramifications on the global market right now. S&P 500 in the futures right now are trading down nearly 2 percentage points, and global markets right now are down roughly across the board around 2 to 3%. Okay, so what's going on here? The idea of negative oil prices in the surface doesn't really make sense. Well, I'm just going to go ahead and explain it very simply, guys. Oil itself can go from becoming an asset that you could sell on the market for some form of value, a commodity that people can use, to something that really nobody wants and comes with a lot of costs. And those costs start to outweigh any benefits that it can provide as being an asset. Because when people stop paying a certain price to utilize oil in the form of refining it and distributing it in the form of gasoline at a distribution center or a gas station, or, for example, making the pavement in this case that you'd see on roadways and highways, or the petroleum products that you see, when there's just such an abundance that we don't need anymore, it actually starts to become a liability. Now, how does that become a liability in this case, right? Can't they just store it or just cut off operations? Well, both of those 2 points are important to keep in mind. First off, the vast majority of oil producers right now, the United States, OPEC nations, Saudi Arabia, and Russia are not cutting production right now. In fact, we're going through what's known as a price war. Now, we've seen these before, and it's where basically a variety of nations across the world who are producing petroleum products and are actually refining oil in this case, and basically drilling nonstop, they're not cutting their production. Right? And this has mainly been going on between Saudi Arabia and Russia, and we've talked about this on the channel. So if you guys are interested in these kind of topics and you aren't already subscribed, definitely consider it. But we talk about things like this a lot. We've been discussing it really for the last year and a half. I've been bearish in oil markets since about $60 a barrel. And I'll be honest, even I couldn't have fathomed this reality of negative oil prices. But there's a second catch, as we talked about just a moment ago, and that is the cost in order to store petroleum products. And this is the biggest issue right here. That basically the centers in this case that can actually store those large gallons of petroleum, in this case of crude oil, right? It costs a lot of money, right? And there is a cost associated to it, to where at the end of the day, there can be a reality of negative oil prices. Oil can become a liability where no one will buy it because there's just such a glutton supply, and you're basically your process of drilling oil out of the ground in this case is running and operating, and it's very difficult to shut down. I want to make that very clear. That kind of helps explain things. It's not easy to shut down these operations, guys. These are usually planned out 2 to 3 years in advance, and once you cancel them, they are not coming back online for years to come. Plain and simple. It's just how the oil industry works. There's a lot of complexities in regards to the process of actually starting one of these operations. So this idea of negative oil prices actually kind of makes sense on the surface. It's something that, again, I think showcases that we've got a massive dichotomy between the excessive supply in the system, but also a stagnant and weakened level of demand with COVID-19 going on, where everyone's staying at home. I mean, this is an unprecedented drop in demand at a time of unprecedented supply. Just when a couple of decades ago, we thought we were hitting peak oil, it was the end of the world, we wouldn't have enough oil for everyone. Well, free markets, technology tend to suffice, and they have yet again proven that we have an abundance on this planet. Now, in the sense of talking about this being a short-term or long-term phenomena, I'm going to go ahead and be very realistic with you guys. This will go on as long as Saudi Arabia, as Russia, as the United States, other OPEC nations, and just countries across the world don't cut production until that supply comes down to meet the demand. And I think it's going to be both forces coming back into neutral territory as the economy reopens. We get a lot of non-essential employees back to work, traveling again. And you also have the supply coming down. You're going to meet somewhere in the middle. And I think that that's going to come somewhere. If I really had to guess, again, it's nothing more than a guess, I think it's going to come in the next 2 to 3 months. I think we're going to see normalization back to a price range of around $20 to $40 a barrel for oil in the next 2 to 3 months. It's going to be a very stark reaction across the board in the sense of the supply side and also on the demand side as we get people back to work to some capacity. Now, that all being said, right, this can persist as long as these producers want to keep running cash into the system. Everyone's losing with negative oil prices. There's no one who's winning at this point. And because of that, I think it's going to be much sooner rather than later that we come to the negotiation table. We're really here over the next few weeks. I think the sheer fact that we saw negative oil prices is going to be enough of a kind of like psychological milestone to get everyone at the table really talking about this. But again, yeah, just wanted to talk about this. Now, to be fair here, we have seen this before. This is, for example, a phenomena we saw here in a sort of type of crude oil known as North Dakota sour crude. So I'm assuming in this case sour crude being extracted in this case from North Dakota specifically, big state for fracking and petroleum products, being briefly priced at negative 50 cents a barrel. So we had seen this before back in, and from my understanding, the last major downturn 4 years ago, back in 2015 and 2016, where we actually saw things briefly go down to negative 50 cents. So in the grand scheme of things, yes, we've seen this before, but this is really the first time we've seen it on the broadly traded petroleum or crude oil products in this case. So very interesting to keep in mind here. So now that we've talked about this, right? You know, I think this is an interesting point here. You know, we're seeing a lot of interesting changes in the world of finance. We're not just seeing, for example, the Fed print money into oblivion. We're not just seeing the Fed funds rate go back down to zero and possibly, as we've talked about for over a year and a half now, the possibility of negative interest rates. Another thing we talked about, negative treasury yields, right? We're down to 0.03 right now, but just back here on March 26th, we went all the way down on the 2-month yield for treasuries down to negative 0.17%. This has been a phenomenon we've seen in Europe and Japan for a long period of time, and now we're seeing it on U.S. treasuries, the world-renowned asset, the asset that's used in, for example, trading and investing, ratios, in this case, like the Sharpe ratio, that's used as a kind of guaranteed return. Well, now your guaranteed return is negative in many cases, as well as the 6-month yield. We also saw the same thing here when we went negative, and we're still hanging very low here. And the FDIC, because interest rates and the Fed funds rate are so low, we're now at a point where the average national savings rate is 0.07%. I mean, guys, if this isn't an interesting mix, a cocktail for disaster, I don't know what is. I mean, when you're at this point here where oil is in such abundance that we're in negative prices, I mean, what this really means for the economy is a very negative cycle here over the next few days. We've not only got all this stuff going on that are going to have very, very long-term ramifications, but on this topic of negative oil prices, there's something very important to keep in mind here that they talk about in this Bloomberg article that we have here. And basically, the problem in this case is that at the end of the day, what you're going to have is eventual cuts. There will be price normalization for oil. But what's going to happen here first, even as we start getting some of these initial cuts, is there is going to be massive cuts to production, therefore massive layoffs, massive cuts to GDP and economic activity in the energy sector. And this is going to lead to even less demand for oil. And it's going to stagnate a lot of the effect of those initial cuts throughout the market. And it's going to put a huge hit on incomes and employment in the United States, even at a time where we're already doing very, very bad with COVID-19. So again, I understand at the end of the day, guys, I'm all of a proponent for renewables and stuff. I don't want to see the oil sector remain for the next few decades. But I'm just saying in the short term, this is going to have some effects that we should keep in mind at the end of the day, right? It's a very tragic scenario in this case, in the sense of the shorter term impacts that it's going to have. And in the long term, maybe this will push people to start looking for alternatives in the long term, alternative energy sources. But again, in Bloomberg, they talk about solar in some areas of California during peak production, during peak sun throughout the day and stuff, and then along with that as well, at a time where people aren't consuming as much electricity at the grid, power can actually be negative. So this phenomena goes across all energy markets. It's very interesting. I'd like to know what you guys think about this, though. Do you think this topic is interesting or fascinating to some capacity? If you like the video, drop a like. If you got something to say, whether you agree or disagree with me, leave a comment down below. And I'd love to get a discussion going on with you guys. But that all being said, let's go ahead, and for those of you who are interested in crypto, let's go ahead and dive into this really interesting interview with the Ty and talk about a lot of interesting topics, from the halving event to also my general predictions for crypto markets, as well as how I approach crypto markets. All right, so let's go ahead and dive into it.
I'm Joshua Franks, co-founder and CEO of The Ty. I'm here with Nicholas Merton from DataDash, recording for the eToro Quarterly Report. So Nicholas, a few questions for you. The first is, how did the macroeconomic climate this past quarter affect how you traded?
Yeah, well, thank you, Josh, for having me. I would say in the sense of the macro environment, we're seeing a lot of interesting things going on. We were pretty early to noticing what was going on with COVID-19. For me personally, I'm looking for anything that's going to benefit in an environment with excessive central bank monetary policy. So I think we've already seen the Federal Reserve promising to inject over $4 trillion over the next coming weeks is going to provide a very clear response for a lot of hedging assets that can hedge against inflation, such as gold, silver, and Bitcoin. I think is an emerging store of value. And then you also have a secondary pressure from central banks, which is the concept of negative interest rates. So we're getting to a point now where it's not just the European Union as well as Japan experiencing a lot of negative interest rates. So when you have money in a savings account, or if you're holding treasuries, you're likely experiencing almost a penalizing yield for holding those assets or having your money in savings. So now I think we're going to get to a point here very shortly where any assets that don't penalize you for owning them, even though they don't provide a yield, are going to get a lot of demand. And the only three assets I can think of that do that or can guarantee that are gold, Bitcoin, and silver. So those are really my three assets I'm watching for 2020 and beyond.
So looking back at this past quarter, how did, if it did, how did your portfolio allocation change between different assets? And did it change at all after that, bloody Thursday or Black Thursday for Bitcoin on March 12th?
Yeah, so I've actually scaled fully out of equities back in 2018. So right now we're actually, in the sense, we made a good call. We got out in October of 2018. That's when I officially flipped bearish in equities. So I haven't seen too much change. More than anything, though, I'm setting aside a cash reserve for basically the bottom in equities that I think is going to come probably in the next couple of months to the next year or two. It's a pretty wide time frame depending on how COVID-19 plays out. But the next area I would look to add to outside of the positions I already own is probably equities at a discount. I think central bank monetary policy will be able to keep equities afloat. But at the same time, I do believe that we are going to step into a drawn out sideways market as we enter in, rather into a recession, but rather into a depression.
Did you pull out of any crypto holdings last quarter to move more towards cash as you saw that crash?
No, I actually, because the thing is, in the short term for me, I'm not a short term trader when it comes to crypto. I focus much more as a macro trader, swing trader. So my positions at a minimum are usually going to be held for a multitude of months to a couple of years. And my whole goal and target is to focus on the next peak for Bitcoin. I believe that we're going to get a 5x from the previous high. I think we're going to $100,000 for this next cycle. And I believe we're going to reach that range sometime in late 2022 to late 2023. So that's a much longer time frame than most people, but I still have that optimistic price target from the current price of around a little under $7,000.
Cool. And so so this past quarter, we kind of saw, I guess what a lot of people would view as a surprising correlation between Bitcoin and the S&P 500, where the decline of the S&P, moved in lockstep for much of this past quarter. With Bitcoin, is that something that you had anticipated and that you had expected?
It's not something that I per se anticipated, but I think there's an easy explanation, and it's why I wouldn't go towards saying that they're directly correlated. I first usually wouldn't use a month's worth of price action, or even a week, or even a couple of months as a means to say that there's a correlation. But I think there's a very clear explanation as to why we saw such a stark sell-off in both Bitcoin and the S&P 500. As equities, as a much broader market, started to experience a correction, I think we got to a point where people were now basically short on the ability to get positions in dollars. You could see the order book was being cleared for stocks. This was the worst sell-off we've ever seen in stock market history, in the sense of the severity and the pace of the sell-off and the increase in volatility. And I think that also is going to be reflected in just about any market. We saw in gold and silver, for example, start decline, even though these are time-tested assets that hedge against market fear. So I think this is a broad demand for dollars in a time where there wasn't much available dollars on the market. A lot of people always forget when you're trading against a dollar pair and you sell a stock or you sell Bitcoin, you're taking a net long position on the dollar. And usually, if an equity, for example, or Bitcoin drops 50%, your dollar can now purchase twice as much of that asset. So I think at the end of the day, people didn't realize just how much there was a lack of liquidity in the system. And that's what led to this stark kind of shock in the market across the board and a need for dollars.
So yeah, I mean, I guess given your last answer, I kind of know what your answer is going to be for this one. But do you think that the Bitcoin as a hedge against macroeconomic uncertainty narrative was proven false at all this past quarter?
I don't think it was per se proven false. The vast majority of Bitcoin's history, Bitcoin has still remained at the point where either someone's bought it or they've actually made a return even after this correction. Luckily, we've actually regained, similar to gold's, the vast majority of the losses. So what I like to see is how gold made a rebound. Bitcoin has also made a rebound during this time. But at the end of the day, I don't even want to say I'm too confident on the other flip side of saying that it is a hedging asset. I think we're going to have to see that over the next 2 years. And that's going to really come into fruition, I think, after the halving event, because you have kind of the perfect change for Bitcoin coming at the perfect time. You have this period of time where in the next month, we are going to experience a massive supply shock to the new issuance of Bitcoin, a fixed monetary policy change, where instead of having a certain amount of Bitcoin be produced now, we're going to have half of that produced every 10 minutes. So basically, you have a huge supply shock. And if you maintain general demand over the next coming months, that's already going to manifest or basically higher pressure on the price of Bitcoin as it would with any kind of commodity or asset. And along with that as well, you've got the macro environment where people are going to look for something that isn't penalizing them for holding it and also isn't printed into oblivion. So if you talk about the trillions of dollars that are stored in currency markets from major world reserve currencies like the dollar to the euro, and you also talk about the money that's parked in equity markets and property markets and also traditional bonds that are probably going to be flowing out due to risk avoidance in this case, then I think you're going to see some of that, even just a fraction of that going to Bitcoin. And that could really push us towards that multi-trillion-dollar market cap that's going to get us to $100,000. I know it sounds crazy, but again, it's the macro perspective. It's the longer term viewpoint.
And so what advice would you give to somebody outside of crypto looking in, right? Maybe somebody who this past quarter was mostly allocated to equities and pulled out some of their capital, or is now looking at the market and saying, hey, there's no opportunities for me to play here. I'm nervous. Where can I kind of, learn more about Bitcoin? What resources should I be looking at?
Yeah, so I am someone who's actually quite different than most in saying that you don't have to fully technically understand Bitcoin. I would assume that the vast majority of people investing in stocks don't look at the full books of every company they invest in. They don't understand every single business practice. And that's the same with Bitcoin, right? You have to generally have a decent understanding, I think, if you want to invest in Bitcoin and digital assets. And the key thing to understand is that these assets are limited in nature. They are traceable in this case, they are transparent, and they're trustless to a large degree compared to traditional assets. So these benefits that Bitcoin has operated for the last 10 years without failure, never shutting down as a network, provides it to be a very reliable asset in that case. And I would say not to go all in on Bitcoin, but also not have any position. Again, I'm not a financial advisor. I can't directly, tell people what to do, but for like an average portfolio, putting in about 5 or 10% of funds, I think, at least for me personally, is something I'd be comfortable with, having about 5 or 10% of my wealth exposed to this new asset class. Because if, let's say, for example, the bad case scenario goes for Bitcoin, Bitcoin goes to zero, it's not the end of the world. If Bitcoin, however, does become this ultimate hedge and the new store of value compared to all of the major trillions of dollars worth of currencies that are currently existing in the world, then in this case, you have a large return for a minimal amount of risk. So for a macro trader like myself, that's usually an opportunity that you can't pass up. So again, just my perspective on it, but I would say more than anything to see how Bitcoin has over the longer term set higher lows and higher highs. That's what you want to see in any given asset if you're planning for retirement or just the future and saving your wealth.
So it sounds like you're more macro in your view and kind of how you trade. But if you were making trades this quarter, and the answer may be no, what were your biggest mistakes and the best calls that you had this past quarter?
I would say more than anything on some of my altcoin positions or basically alternative cryptocurrencies that aren't Bitcoin. The biggest mistake I made is not having some stop set on a lot of my altcoins that have gained over the last couple of months. we saw just as much of a bloodbath in the altcoin space than we did with Bitcoin. So I would say more than anything, making sure to, if you're going to be trading, at least on the positions you're trading, not investing in, I would say to be able to set stops in this case. A lot of people in crypto don't do it. The reason for me is that I was planning to simply hold them for the longer term. But in reality, at the end of the day, it's better to take profits because you can see really in a matter of just 2 weeks, a lot of those gains get wiped away that you had built up over the past few months. And that's just how crypto markets can move sometimes.
Yeah, totally. And so I guess related to that point as well, or what if any altcoins surprised you this past quarter?
Um, Man, it's an interesting question. There's so many to keep up with. I would say the ones that have really intrigued me were basically the ones that have basically been a part of what's known as the DeFi movement or decentralized finance movement. One of those would be Kyber Network, which is focusing on building decentralized exchanges. I've been a supporter of the project as far back as 2017, but I really started to build a position back in, I think, late 2019 or early 2020. And this one has basically just blown up as of recent because they've been having a lot of major upgrades that are coming to the network. They're seeing a lot of traction in the sense of volume and use case. And what was really kind of this far-fetched concept back 2 years ago of basically providing a way where you and I could trade without an intermediary or having to trust some kind of centralized institution like a bank or exchange is now becoming a reality, which is really exciting. So I would say more than anything, Kyber Network's been interesting to me. Outside of that as well, Chainlink is very interesting. This has been another one that's focusing on fixing a massive issue for networks like Ethereum and utilizing a lot of interesting technologies that have come out of the blockchain movement, such as smart contracts. Again, probably a topic for another time, but I would say that these two have been some of the more interesting ones, and they've been some of the better performing in the market as well.
And so what, if any, developments have you excited for Q2? It could be a new mass market product that's going to bring more people into crypto. It can be some sort of, upgrade or, to a mainnet or development on a network. It could be some sort of regulatory thing, but what has you excited?
Yeah, man. Well, I don't mean to toot my own horn. You're talking about like a mass product to bring in more people into crypto. That's something that I am planning to launch sometime in Q2 of this year. So I'm very excited to get it's a startup that I've been working on for a while. And again, the single goal is that it's basically to make crypto easy for everyone. So I'm excited to get that launched. Outside of that as well, I would say that the biggest thing I'm seeing is that throughout the DeFi space, there's so much utility that's been built through all these applications. And I think what you're going to see over the next coming months is that we have much less of an emphasis on trying to extensively explain the technology to everyone and rather focus on the clear utilities that the space offers. I always try to build an equivalency. It would be like me, for example, living in a world where if I wanted to message you on Facebook, Joshua, I'd have to know some long strung out digital address that identifies your account, like an ID address in this case, or I would have to know how to understand TCP and all these different internet protocols, which at the end of the day, no one has to understand. It's only those who work behind the scenes and build these applications who have to understand it. At the end of the day, I just need to know, does it work? And that's what most people care about. So I think the moment we can get that, and I think we will get that in Q2 and Q3 this year, you're going to see a massive growth in the crypto space over the next coming years. And it's just going to be a larger and larger cycle with more and more people coming into the movement.
And so final question is, where can people find out more about you, learn about what you do?
Yeah, so I run a YouTube channel called Data Dash. If you simply look up Data Dash on YouTube, you'll be able to find me. Along with that as well, you can find me over at Twitter at Nicholas_Merton, where I post not on a daily basis, but pretty frequently if I find some interesting material, and just try to keep people up to date on, not only cryptocurrency markets, but equities and commodities and a little bit of Forex markets sometimes, but just providing, again, as you mentioned, Joshua, that macro perspective. So if you find anything we talked about interesting here, feel free to check me out on these different platforms.